Hello, welcome, dear investors, listening to me about investing passively for the long term, in this case, and in particular, we continue to discuss and respond to the question raised by one of my viewers, and that is Asha Kijana. So Asha, once again, thank you very much, and I hope you continue to watch and listen to my presentations. We have discussed unit trusts, we have discussed property, and we also discussed SACCOs, or by extension you could say investment groups, as an avenue for long-term investing. Today, or rather in this particular episode, I would like to discuss provident funds, which I mentioned in the introduction. Provident funds as an avenue for long-term investment. Basically, relatively trouble-free or risk-free or low-risk avenue for long-term investing. Now, if you remember, during the intro a few videos ago, I gave you some examples of provident funds. But before the examples, I say a provident fund is basically an investment vehicle which would give you or provide a lump sum payment at the end of a period of time. Usually that period of time would coincide with maybe the end of your employment, for example. So there are many provident funds that you'd find provided by employers to give you some lump sum. So it's essentially you're funding your, if you like, retirement or end of employment package. Okay? That's essentially what a provident fund is all about. So by way of examples, you can have what they call gratuity funds. In some employers or companies, you will hear of staff pension funds. You will hear of, or you could have umbrella funds being provided by asset managers. In many of our countries, you would have the National Social Security Fund or an equivalent fund provided nationally, where employers are mandated to remit certain deductions from the salaries of their employees together with their, that is, employers' contributions for purposes of your retirement package. I have mentioned that staff pension funds could also be one of these now. Well, a pension fund may not necessarily be a provident fund, but in this case, in some cases, upon maturity or when you retire at the end of your employment, your employer can give you an option to either take a lump sum, which is essentially what the provident fund would be about, or to convert the amount that will have accrued to your account into a pension. Pension means periodic payments, basically for the rest of your life. Or in some cases, it could be both. They could give you an option to take some of your money as a lump sum, but then leave the other, or the other amount, to be converted into a pension. You can always discuss this with your, find out whether this is available or what the options are with your employer. I'm not saying that this applies everywhere, not at all. But I do know that there are some employers who give you such options, and that's why I'm also talking of staff pension funds. But bottom line is, at the end of your employment, a certain amount of money will have accrued or accumulated and will be available for you to take home as your retirement package. Okay, this is the essence of provident funds. And it is an important way of long-term investing in a risk-free or a low-risk manner. It's a very, very important vehicle that I would always want you to think about, a way of putting aside part of your salary. So essentially what would happen is that every month a part of your salary is remitted to this investment fund. And again, depending on the regulations or the structure of the fund with your particular employer, the employer could actually put a part or some money proportional to how much or what proportion of your salary has gone or has been remitted or is being remitted into the fund. So for instance, in some cases, they would say, well, if 5% of your salary is going into the fund, maybe the employer will put the same amount, or the employer could put 10% of your salary. Again, those are details that you need to find out. But you realize one thing, that this actually could be a way for you to, quote unquote, negotiate or get a better package, if you like, a salary raise of sorts from your employer. If the employer is promising or willing to match, say, shilling for shilling, dollar for dollar, what you are willing to invest from your salary into the gratuity fund or whatever provident fund. So one thing that you could do is to raise your contribution above the minimum. So if the minimum is 5%, you don't have to put only 5% of your salary. You could do 10%. And if you're lucky that the employer is then willing to match shilling for shilling, well, then right there you are actually getting a raise. I'm not saying that that will always happen, but the fundamental thing I'm saying is look at this as an important vehicle for long-term investment in a risk-free or a low-risk manner, and always take advantage of it and make sure that you invest as much as possible, divert as much of your salary as you can comfortably afford towards this investment, which then should ensure that you have a reasonable package when you leave the employment of that particular company. And also, do not forget, at the end of the employment, as I said, some employers will give you the option of converting some of your money into a pension. Well, you need to then think about such options too. But broadly, this is an option that you should look at, provident funds as an avenue for long-term investment in a low-risk manner. Do ask me questions anytime. Write to me, send me a WhatsApp, or use whatever avenue to get to me, and I'll be more than happy to respond to you. But in your respective countries, you will have lots of investment advisors, people you can talk to get details about all these options. So Asha, this is the last video responding to your question, and I would like to thank you for asking the question, and I hope that the response has been useful not only to you but to all the other viewers and listeners. Thank you very much, and I'll talk to you again in subsequent videos. Thank you.